Hey everyone, Kirk here again at optionalpha.com, where we show you how to make smarter trades. In tonight's video update, I want to go through all the closing trades that we had on Thursday, September 14th. Hopefully, actually, this new microphone that I have when I'm traveling sounds a little bit better because I added a pop filter to it. So you guys got to let me know in the comments or shoot me an email if it sounds a little bit better. A little bit more clean and crisp, hopefully, for you. But first things first, I actually want to go through short call dividend assignment risk. I know that's a mouthful for you guys, but I got a bombardment of emails today from people who are worried about short call dividend assignment risk, and particularly in XLF and then XLV, etc. And as always, I would direct most people first to the knowledge base, because we have inside of the knowledge base a very good video tutorial called short call dividend assignment risk. It goes through the exact mechanics of if you are at risk of assignment or not, or how to kind of basically like learn how you're at risk of assignment or not. Now, a couple of people got a little bit confrontational with me that they wanted a straight answer, like, Kirk, why don't you just give me the answer? Why don't you just tell me? And it would be easy for me to tell you. I could tell everyone, no, we're not at risk of assignment for XLV. No, we weren't at risk of assignment for XLF, right? But that doesn't help you in any way, shape, or form. And so when I try to do that, just so you guys know, so everyone's clear, when I try to push you to a video tutorial or check out this or read this blog post or listen to this podcast, it's because I want you to learn how to do it by yourself. I want you to learn how to fish by yourself. And so you could always come to me and say, are we at risk? And I could say no or yes, right? But that doesn't do you any good, and it doesn't do me any good, because then I got to reply to a million emails from people. I want you to learn how to do it. So if you got an email from me today and it was short and it was brief and it was saying, hey, go check out this video, is because I want you to learn how to do it by yourself. As always, the major part with short call dividend assignment risk is the corresponding put option. So in the case of XLV, you can see that their dividend is going to be roughly like 30 cents or so, could be even higher, right? But our corresponding in the money short calls, right? So we've got short calls at 81. The corresponding puts have to be less in value than the dividend being paid. If they are, then you might be at risk of assignment. But if they're not, and in this case, both of them were not, right? Where we had the 81 puts that were worth $50, the 83 puts that were worth $114, definitely not less than the dividend that's going to be paid. And for that reason, then, you're probably not at risk of assignment, right? That it would be inefficient for the option buyer then to assign, collect the dividend, and then buy the put option, which is what they would do. And so that's why you have to check that out. Now, all brokers are required just by law just to let you know. And that kind of freaks people out in the most, for the most part. But you need to know how to do this by yourself. And that's really kind of like a key skill, I guess, for sure. So again, if you were pointed in that direction today, it wasn't me trying necessarily to be short. I wasn't trying to, rush and get rid of your email. It was because I wanted you to learn how to do this by yourself. And I know a lot of people do, but it's worth mentioning again here. So as far as today goes, it's just, again, more cleaning up of the portfolio, really kind of the positions that were still on the books that we have. We still have our VIX position as well that we still have to manage, but that's really a full profit. We're kind of just waiting, to really kind of squeeze every last ounce out of that, which will probably just close tomorrow. So we're not going to hold that any longer. We'll probably just close it early tomorrow. But as far as other trades go, we did close out of our QQQ Iron Butterfly that we had. This is the one that we adjusted into. So we originally sold the call spread. The markets rallied. We added the put spread. That put spread, by the way, really kind of like helped us, carve off of this loss, probably about, $100 or so, 100 plus bucks, because we sold that put spread for some premium, adjusted this position, and the market, continued to move higher. And this is, I guess, a case where, again, with these adjustments, your first order of business is not necessarily to adjust into a more profitable trade. It's to adjust to reduce risk. And that's exactly what this put spread did. This put spread we bought back for, basically pennies, but it was pretty, we don't want anything to happen tomorrow and it to go in the money. But it definitely helped, cut down on this loss for this position. So it was still manageable though. Small loss, $248 on the Qs trade. The TLT position that we had left over for September, if you remember, we had two TLT Iron Butterflies, one centered at 124. We got assigned on that. There's video tutorials on how we kind of dealt with the assignment, but it wasn't that bad. We kind of managed around it, and that was good. And we collected a pretty decent premium, so that helped, cover that assignment for sure. And then we had this 126 Iron Butterfly that we adjusted. So we originally sold the 126 Iron Butterfly for like $270 or so, and then rolled up our puts. And when inverted by $2, to collect an additional premium. So all we had to buy back was the inverted strikes, which is the 126 call and the 128 put. Now again, with these, and we mentioned this last week to elite members on the strategy call, with TLT trading in between this range, right? Our ideal situation is for TLT to trade between 126 and 128, and that's where it's sat basically for the last couple days. And so what we've been doing is we've just been idly waiting and buying our time for time decay to kind of kick in, and it really kind of helped accelerate this over the last couple of days to the point at which, we probably ended up getting another $50-$60 on this thing just in waiting and time decay. But with these inverted spreads, again, the minimum that they can trade for is the width of the inverted strike, which is $2. So we paid a little bit more than that, but it's not worth holding to make an extra $10. It will not trade anywhere below $2. And that's okay, because all the credits that we added up still gave us an overall profit of $250 on the trade, okay? The other one that we have here is our XLF position. This one is one that we adjusted as well. We went inverted on this by about $1. Originally sold it for like 96, added an adjustment for 16 cents, and then bought this thing back now for 113. So I think it's, or it's somewhere around there. Don't quote me on those, but somewhere very close to those prices. But anyways, it ended up being just kind of a scratch trade. And again, this is one that really, should have traded much closer to that $1, which is the minimum value, the width of the inverted spread here, but didn't. I mean, it just, last like couple days, it's just really been hovering around this 112, 113 region, even though it's been, trading right where we want it to be. And again, that was between 25 and 24. And so it's been trading in that range, which is great. It's just been hovering in that realm and hasn't really moved. So we just figured, look, it's the scratch trade. We're getting so close to expiration. You don't want to run the risk of being assigned on either side and having to go through that situation. So we ended up closing the position and removing the risk. Again, as far as other positions that are just kind of left in the portfolio right now, I think the only one for September that we have right now is our VIX position. It's pretty much at full profit. Now I had a working order in there. I think it got canceled because I'll put it back in tomorrow, but I had a working order in there for like 195. This thing should trade pretty close to 195 tomorrow, and so we could probably get another 20 or 30 bucks out of it as far as potential profit. But it's a very, very profitable trade with our VIX put debit spread. We're just waiting to get it off, right? And I've said this from day one with the VIX trade. It's a hedge against the market going higher, and so for us, even if the market has a down move tomorrow, this thing should pretty much start to really decay at a good pace before the weekend. So I think we'll probably get this thing off and not run the risk of holding it over the weekend. So definitely be on the lookout for that trade tomorrow when the market opens up. So as always, if you guys have any comments or questions, let me know. Add them in the comment section right below. And until next time, happy trading.